Welcome to the table for the Friday, February 28, 2025 installment of Market Plus. Joining us now is Sue Martin. I always have to interrupt her, and I apologize, but we just covered like 3 or 4 things. This plus is going to be loaded, so I have to just start with the question. We can't even say hello to each other. Oh, I'll say hello. All right, let's start with Gary in Wisconsin, please. Ag Forum's 94 million acre corn crop number seemed to be what many thought it would be. Was the price reaction more about tariff announcements or the Ag Forum's numbers?
I think it was more about the Ag Forum that started it. Everybody knew President Trump had given him until March 4th. And then we did this little dance where first we were hearing out of Reuters and Politico that it was going to be April and extended. And then on Truth Social, he made a comment, no, the tariffs were going to stand. You know, this is kind of similar to what we did in January before they started in February and got extended. So nothing shocks me here.
So how does a producer at home navigate, not necessarily the news, but the volatility?
Well, and that's a good question because this volatility is a good thing for a producer that wants to sell. Not so great when it takes the elevator shaft, but when you want to sell, you're getting that volatility, which gives you those nice reaches for prices, and you need to take advantage of it. But I have to say, if you're, first off, a livestock producer, and you're feeding cattle or hogs, my suggestion is using this break that we're into, and it could last all the way into April if it wanted to. Use this break and get some call spreads done. And I'm saying call spreads to cheapen the expense because of the volatility in the market. That's making options more expensive. So do call spreads, but you have to manage the one you're selling, which would be buying a call, selling out of the money call. And then that puts a floor, or how do I want to say this? It puts a floor under how much you're going to, if prices turn and take off, you're going to have, as an end user, you're going to have your floor in place to protect you. If the prices continue to drop, you get the win of that you can buy cheaper. Now, if you're a producer of grain, then you want to be doing the opposite. And as the market goes higher, if you haven't made sales, then you want to take and do put spreads. But on the same token, if you have made sales, or if you, and I'm hearing this quite a bit this year, that there's accumulator contracts that people are doing. Well, take advantage of call spreads then and protect yourself on the upside because this year's volatile. This year is very similar to 1994, 95, and 95 to 96 crop year. Very similar. It's also the only year ending in a 5 since 1915 that we had a bull market.
Go back to accumulator contract. Tell me what that is.
Well, it's where you get a price level and you sell so much. And then as it continues up, if it hits a certain price level, you have to come in with, like, say, maybe just as an example of explanation, maybe 2 or 3 times more grain than what you, at the original selling price than what you had.
You have just laid out in the last 3 minutes some very complicated moves and things that are available that are out there. Is this one of the more, I won't say risky, but rocky times that farmers, not necessarily with prices and policy and things like that, but just trying to navigate this? You have to be very careful.
Well, they have to be very careful, and that's why I recommend the options because it protects them.
Okay.
But yet they're not putting out an awful lot of money because they're selling calls. Now, make no mistake, as if the market starts to rally, and say you bought, say in Dees corn or Sep corn, a 460 call, and you sold a 520 or a 530, and the market takes off and runs because while May and July corn made new highs on those contracts for the year, and also for a lead contract, we have made new highs for the year, which is very positive in a way. We have to understand that last year, the low was 360.5 on a lead contract. Well, in all odds now, we're probably not going through that. So that puts a floor under that. The Dees contract's low was 380.5. Therefore, there is nothing saying December corn can't go right on down, take 380.5 out, because it has not made new highs for the year on its contract. However, the thing that I want to stress is farmers last year, we all know, didn't sell, and it wasn't just one or two or whatever. Misery loves company. They all did the same thing. So they didn't make sales until late and into harvest, which is a horrible time to have to make sales. Then the market comes out of that and looking better than they expected, so they were willing to take advantage of and sell grain. So 80% of the crop is sold. I would say a bigger chunk of it was sold before the government report came out and surprised everybody. Okay, now the next thing is that in 1994, farmers did very similar, the same thing. In 95, they had that crop sold, the old crop, and by the 4th of July or right around there, farmers had already priced probably most all the grain they were going to sell off the combine. And at the time, hedge-to-arrives were very sexy. And so then that puts a large short position, which means there's not going to be any hedge pressure in the fall. Then comes Japan, steps in and starts buying hook, line, and sinker.
Which we could see another buyer come in. The world has changed. But let's talk about buying. You mentioned money, currency I need to discuss because of this trade discussions, the peso in Canada, in China. What is going on with currencies that we need to be aware of?
Well, see, this is one thing that I think, Paul, that you don't hardly hear anyone in the trade talking about, but the dollar is very strong. And when you look at the peso, it's been on its face. You look at the Canadian dollar, it's on its face. So when we turn around and bring cattle in from Mexico to the U.S., if we're bringing them in, there's a 25% tariff that's going to probably go into effect on those. But if it's a U.S. buyer bringing them in, well, they're spending less dollars to bring those cattle in. And in the meantime, if it's someone who's buying something from Mexico out of the U.S., like corn, they're our biggest corn buyer, well, they're going to have to pay a whole lot more for that corn because of the 25% tariff on top of the currency exchange, more pesos versus a high dollar. And nobody's paying attention to that. And so therefore, just because, and I think that's why feeders have rallied, is because of this on and off situation with the tariffs.
All right, let's do one last question. You can take a drink if you need to.
Thank you.
That's okay. Let's do Kevin's question because this is the last thing I want to cover here, Sue. And Kevin is asking, can farmers borrow the money for the extra corn acres? Bankers might say, no more money though.
Well, I think if they're in good enough standing with their banks, they'll be able to do so. But also, it just says if you're going to plant more acres, and of course the input costs on corn is higher than it is for beans, and then I go into that spring weather, I'm not sure we're going to get as many acres as we think we are this year. But what's going to be interesting is, and if that be the case, then that means more bean acres shift over. But what happens is that crop insurance, being able to utilize the options and protect yourself, yeah, then I'd say go ahead. Because I think that this corn market has already set itself, but just realize there's still a downside here because we're up here and all these lows from last year of 2024 is quite a bit below us. So I do think that we won't see a move back. And if you're catching a cold, wet spring, granted it delays the planting, but more importantly, as it delays the planting, it could shove that crop into pollination of the hottest time of the year. And look at our weather patterns, vacillating, about like the market is these days, vacillating, 2-3 weeks of bitterly cold weather, wet weather. then it's above normal temperatures. It's one extreme to the other. We may see that all summer.
Have those ridiculously cold, wet spring, followed by a really hot pollination on
Yes.
to the end.
Yeah.
Yeah. Well, I guess we'll have you back. We'll see how it all plays out.
Yes.
All right. Sue, good
Hail
to see
Mary,
you.
full of grace.
You bet. Thank you so much.
Thank you.
All right. Sue Martin, everyone. I do want to remind everybody to get signed up for that Market to Market Insider newsletter. That's how you knew that Sue was going to be here. It is free. Sign up at markettomarket.org. Next week, we are going to talk about a school that won't let agriculture be secondary, even at the primary level. And we'll have the commodity market analysis with Sean Hackett. Thank you for joining us, and have a great week.